Hello and welcome to Earnings Echo. We put together the most important information about Oscar Health.
We're looking at a fascinating report today, a real tale of two stories. You have the past performance versus this massive future guidance.
A total divergence. So let's start with the hard numbers. Walk us through the Q4 and full year 2025 results.
Right. So for the full year 2025, total revenue hit $11.7 billion.
Which is up a healthy 28% year over year.
It is. But that's where the good news kind of stops. The profitability just wasn't there. They posted an operating loss of $396 million.
A big miss then, driven by higher costs.
A huge miss. And yes, driven almost entirely by a spike in medical costs.
Okay, but then the market reaction was odd. The stock actually staged a comeback. It dropped at the open, but then rallied.
It did, a complete intraday turnaround. It closed up 6%. The market essentially decided to ignore the 2025 loss.
Because they were looking at the 2026 guidance.
The 2026 guidance is the entire story here. Management is forecasting revenue between $18.7 and $19 billion.
Wait, say that again? $18.7 billion?
That's right. And to give you some context, the analyst consensus was sitting around, maybe $13 billion.
So that's, what, 45% higher than what Wall Street was expecting?
Almost exactly. A massive, massive beat on the outlook.
Okay, that's a huge disconnect. But before we get to the 2026 stream, we have to understand the 2025 problem. What drove that loss? You mentioned medical costs.
It all comes down to the medical loss ratio, the MLR. It shot up 570 basis points to 87.4%.
And what's the reason for that?
Well, management pointed to two things: market morbidity and the effects of Medicaid redeterminations. Basically, the new members coming in were sicker and needed more care, driving costs up.
Okay, so with that as the backdrop, how in the world do they justify an $18.7 billion revenue floor for 2026?
It's a volume story, pure and simple. As of February 1st, membership hit 3.4 million.
3.4 million. So they basically doubled their market share.
Pretty much. They're at 30% now. They've really hit a critical mass in that individual market.
But what about pricing? The whole sector is worried about the enhanced subsidies expiring.
And that's the interesting part. Oscar seems to have gotten ahead of it. They said their 2026 premiums were priced assuming those subsidies would expire.
So they took a more conservative, defensive posture.
Exactly. It positions them for better margins even if the environment gets tougher, while others might have to scramble.
Let's talk about the earnings call then. What was the tone from the CEO, Mark Bertolini?
He was very clear. He framed 2025 as a reset year. Just get through it. And 2026 is the springboard.
A springboard to what? Profitability.
Yes. They're guiding for $250 to $450 million in operating income next year.
But how? With 3.4 million members, how do they keep administrative costs from just exploding?
Technology. That's their answer for everything. They have this AI agent called Oswell.
I've heard of it.
Well, they claim it's now handling 86% of all member inquiries.
86%.
That's the number. If that's real and it holds, that provides incredible SG&A leverage to handle the growth.
Look, but it can't all be that simple. There has to be a risk. What did they flag?
They did. They flagged a big one, actually. A churn risk tied to what they call passive enrollment.
Meaning people who were auto-renewed but might not realize their new premium yet.
Exactly. They think about 400,000 members could churn out in Q1 once they get that first bill, especially with the subsidy changes.
And I saw they mentioned some niche products like Helomino and ICHRA. Were those major drivers?
Not really. They're interesting, but they're secondary. The core story, the whole thesis, is just about massive scale.
So to wrap this up, what's the main echo for investors here?
The market is treating the Q4 miss like it's already ancient history, a sunk cost. They are pricing the stock today purely on the 2026 revenue visibility.
So it's a bet on scale.
It's a bet that Oscar has finally reached a size where if, and it's a big if, they can get that MLR back down into their guided range of, say, 82 to 83%.
Then the sheer volume of revenue just drops straight to the bottom line.
That's the entire investment case in a nutshell. The execution risk is now all about managing medical costs for those 3.4 million people.
And watching those Q1 retention numbers very closely.
Very, very closely.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.